Welcome to this Killick Explains video on penny shares. Apologies for the fact I'm not back in my studio yet, but I hope to be so once lockdown version 3 comes to an end. So, what are penny shares and what are some of the key risks? Alright, background information first. So, the latest asset class to hit trading apps and chat rooms is the penny share. There are brokers out there who will set up deals in them. There are newspaper columnists writing about them, and the internet has many stories about successes, less so, unsurprisingly, about failures. So what are these things? Why penny share? And what are the key risks that anyone even thinking about going near them should be well aware of first? Well, the basics are these. So in the old days, if you like, the definition was shares that traded for less than $1, or in the UK, £1, hence the expression penny share. But that's an old definition, and these things are not new. They've been around donkey's years. It's just that at the moment, there seems to be a bit of a marketing blitz going on in certain quarters. That's why I'm talking about them now. These days, the SEC definition is more about the attributes that the companies that issue these shares share, and the price can be anything up to more like $5. So don't get too fixated on the term penny share in terms of what you're actually buying. So what are the attributes that would make something with a share price above $1 or above £1 still nonetheless a penny share? Well, that moves us into the key features, and this is very much a potted summary. So you tend to be looking at a small company, small claiming to be fast growing in most cases. It may trade its shares on an exchange like the London Stock Exchange or the New York Stock Exchange, but the reality is many penny shares trade over the counter. That means off exchange. So deals are done, you could see it as privately if you want. You can still buy or sell these things through a broker, but you're not trading using a quoted price in the same way as you would be if you were buying a share available on a public exchange. So you're talking about relatively unknown ventures looking to raise capital, and often they'll dangle the carrot that if you get in now, they are on their way to a proper listing in the future, and there'll be a big multiple to be made, if you like, once the shares go public for investors who get in early. That tends to be the kind of story. So the possible upside, why do people get lulled, if that's the right word, into buying penny shares? Well, the answer is, the story goes that smaller, less well-known companies can be the ones that return the most to investors. Get in before everybody wakes up to the potential, if you like, is often the story, and you may find the share price multiplies very fast, and that could indeed be possibly true. Examples that are often used to market penny shares can include some quite big companies. Because I mentioned that idea that the share price could be up to $5, you'll see Amazon was once a penny stock by that definition because its share price was $2 in 1997. Apple and Advanced Micro Devices, these are pretty big companies, are sometimes used to market the penny share concept. But this is an area that's rife with survivor bias and full of risk, so be careful with the stories. Essentially, you will hear about the successes. That's life, that's survivor bias. You won't hear about the 20 companies that tried to do something similar and went bust or disappeared in the process. So what are the risks around penny stocks that anyone thinking of buying them should be well aware of? Well, I'll summarise a few of the key ones here. One is volatility. These are shares that can rocket in value, yes, but can also drop in value very quickly. And any investor needs to be well aware of that. They're also highly illiquid. These are companies where an investor may struggle to sell a position because there are not enough buyers around to match the trade, and that can lead to wide bid to offer spreads, as they're called. And lower levels of regulation and investor information means it can be quite difficult to piece together just how well a penny stock company is actually doing before you buy the shares. The obvious trading mistake is one that a friend of mine fell into actually, and that's just assuming that a low price means you're getting a bargain. So be careful of buying penny shares simply because they trade at 4p, for example, when in actual fact, rather than not getting any cheaper, as this friend of mine assumed, the answer is they can go to zero, like any share can, and wipe out 100% of your investment. So be careful. The fact that something trades at a low price doesn't necessarily mean that it's a bargain. So to conclusions for anyone thinking of getting involved in penny stocks. Well, my first conclusion is going to be that many people probably shouldn't, but they would be these. This is gambling, not investing. So in other words, make sure you commit small amounts that you're prepared to lose 100% of. Watch out for bid to offer spreads. Ask about them because they can be massive. In other words, the price you're quoted may not be the price you can actually trade at. And do set stop losses to limit the damage if things go wrong where possible. Finally, watch out for the fraudsters operating in this space. The fact there is lower regulation, the fact these are not subjected to the same rules as listed companies, makes it a great place for fraudsters to operate. So there you have it. For more information, editor@killick.com. For other videos related to share trading, killick.com/learn and the shares tab. And if you'd like a copy of my guide, not on penny shares, but how to invest in equities more generally, then do ping me an email.